and welcome to the Oanda MarketPulse Market Snapshot. My name's Craig Erlam, Senior Market Analyst at Oanda. Now, this week in general is looking a little bit quieter than what we had last week. Of course, last week there was the ECB meeting at which the Mario Draghi and policymakers disappointed the markets after building up expectations for aggressive monetary stimulus over the past few weeks. Only announced a small cut to the deposit rate, and a small extension to the quantitative easing program, and increased the number of assets that it could purchase. But really, this was far below expectations, and the markets were very disappointed. Also on Friday, we had the US jobs report, which exceeded expectations and really did leave the door wide open to an interest rate hike from the Federal Reserve when it meets next week. Now, this week is looking a little bit quieter. Really, this is the week that's sandwiched between the two most important weeks of the month. Of course, last week, as we've just gone through, but then next week we've got the Federal Reserve meeting, at which we could see interest rates hiked just before the holiday period at a time of low liquidity, which is one reason why people are questioning the timing of the Fed's interest rate hike. But this week, the focal point is probably going to be more on Asia than it is on Europe and the US, just because of the absence of key economic data. Now, today there's going to be only really a couple of notable releases or events. I think the most notable of which is going to be the Bank of England Governor Mark Carney's speech today. Now, this comes a couple of days before the Bank of England monetary policy decision. Sorry, 3 days before the Bank of England's monetary policy decision. Now, should be noted, no changes expected from the Bank of England both this month but also in the months ahead. Mark Carney's made great efforts to manage expectations after previously claiming that the Bank of England could contemplate an interest rate hike around the turn of the year. More recently, he has pushed back these expectations more towards the end of next year. Now, one thing that I think has been interesting with the Bank of England is they haven't really been clear on when they expect to raise interest rates. What they've said is they've claimed that based on current market expectations for interest rates and current market expectations for inflation, then it would be suitable to potentially consider raising interest rates around the end of next year based on where they expect inflation to go off the back of these figures. So really, they're using market rates as opposed to their own personal data and their own personal expectations. So I find this quite vague, and what I'm hoping personally is over the course of this week we get more indications of what the Bank of England is expecting rather than what the markets are priced in. Because what we know is, from particularly the most recent history, is the markets can quite often price in bad expectations. We've seen it repeatedly with the Fed. Prior to the October meeting, the markets were pricing a 30% chance of a rate hike this year. Now it's 79%, and it's probably going to rise a little more again before the rate decision next week, when we are now expecting rates to be hiked. So we can't really rely too much on market expectations. What I'd like to see from Mark Carney over the course of this week is what the Bank of England is expecting, and I think personally, once the Fed raises rates this month, I think the Bank of England won't be that far behind, especially compared to what we're currently expecting in the markets. I think it's probably going to be more along the lines of the middle of next year. We are seeing tightening labour market conditions, we are seeing slack in the economy deteriorate significantly, and we are seeing wage growth pressures, of course, still below what we want, but we are seeing them grow over the course of the last 6 months. So really, I think the conditions are in place for a hike in the middle of next year. But like I said, I'd like to hear more from Mark Carney today and again on Thursday. We've also got GDP data overnight tonight from Japan. This is the final reading of the GDP release. We're expecting it to be rounded up to 0%, which means the Japanese economy is not in recession as we previously thought, although of course 0% rather than minus 0.2%. There's only a marginal difference, technically speaking, and really the economy is continuing to face strong headwinds and could probably do with more monetary stimulus earlier on next year, although as it stands, the Bank of Japan is very much reluctant to do so. Now, what I want to move on to next is a few charts, because we have seen some interesting moves on the back of Friday's jobs report. The first one I'm going to highlight is, of course, euro-dollar, given the fact that this is the most active pair over the course of the last few trading sessions because of what the ECB did and also what we got from the jobs report as well. Now, we saw this massive rally in the euro against the dollar off the back of this very disappointing ECB monetary policy decision. Now, what I said last week was technically this is a very bullish candle, and if I saw this naturally on a chart, I would be expecting far stronger moves. I'd see 110 to 111 as a big technical resistance level, and once we saw that broken, I would be looking for a move potentially back towards those 114.50 to 115 levels, based on the move that we've seen on Thursday. But the reason why I'm not convinced by this quite yet is simply because of the fundamentals that have driven it, and this has been driven by disappointment rather than something that's technically bullish for the euro. I still think we will see more stimulus from the euro next year, and I think the markets are probably anticipating that as well. I think 108 could potentially offer some support right now. We've seen it offer support repeatedly in the past. We've seen it offer resistance at this point as well. We are seeing it hold up at this level at this time. This would constitute, therefore, a pairing of these gains, which for me is suitable. And then after that, I will be interested to see how we react back at these 110 to 111 levels. I do think we are potentially going to see a little bit more upside than the euro, but 110 to 111 is extremely key for me, because a break of these resistance levels would bring back these moves back towards these 115 to 115 levels into play. Now, if we look back at the 1 hour chart, for example, how it's reacting at this 108, we are clearly seeing the pair find support, which makes me think we are finding at the very least some form of new trading range. We are seeing divergence here. Lower lows in price action, higher lows in the MACD histogram. This bullish divergence shows a lack of momentum in the downward move. Potentially seeing these candles as well. You're seeing this hammer candle. We've seen a spinning top or a doji. Clearly, there's momentum lacking in this downward move in euro, which makes me think that what would really establishing a new trading range at this stage at the very least, and we're probably not going to see a move back towards these 105 levels anytime soon, and I think parity is very much off the cards right now. Euro sterling is another one. Now, what I find more interesting about euro sterling compared to euro dollar right now is, whereas you've got the strong dollar pulling the pair to the downside, you've got a less weak euro pulling it to the upside, and therefore I think we are going to find some stabilisation. The euro has strengthened against the pound based on as a result of these lower expectations from the ECB, but we're not facing this downward pressure from the pound because it's not very strong right now. In fact, given the fact that the Bank of England's expectations have deteriorated in terms of when they expect rates to rise, this potentially has the potential to create some more upward pressure in this pair. This looks more like consolidation than a pairing or an establishing of a new trading range for me. This looks more like consolidation, as you can see, like this kind of flag formation or the falling wedge, and I think we could potentially see a move back towards these 73.90 to 74 levels, where you've got the descending trend line. We've got these previous levels of resistance, so I think we could potentially see more gains in this off the back of that disappointing ECB message that we had last week. One thing I wanted to highlight finally is the fact that we've seen WTI break below $40 a barrel, and I think potentially we could see it move back towards 37.10 to 37 to 38 in the coming days or over the next week or two. This is off the back of OPEC's decision not to cut production or even really consider reducing the ceiling on the current output from around 30 million barrels a day, even with Iran potentially coming back online. The more likely it seems to increase production as opposed to reduce production or even contemplate the idea. So again, they're going to let the market forces play their role, force out higher cost producers, and therefore we could see this year's lows tested in the short term, and I think we could even see the lower 30s tested in the months ahead. So I think we are going to look back potentially towards these 32 levels in the coming months as a result of this stance from OPEC. For more in-depth news and analysis, check out Oanda Market Pulse at MarketPulse.com. You can also find out more about Oanda and sign up for a free demo account at Oanda.com. Here you'll also get access to Oanda Forex Labs, which has a lot of great tools aimed at helping you in your trading.